Hashtag YouTube intro. AI just hit $8.3 billion in a single funding round, and that's not even the biggest story today. We're breaking down 7 massive moves reshaping tech, a SaaS giant defying the market crash, Meta's compute power play, Trump's AI policy flip, PlayStation's death knell for physical media, Claude's surprise comeback, and the funding explosion that's rewriting Silicon Valley's rulebook. Stay till the end for the one announcement that changes everything. Bending spoons defies SaaS slump, surges 40% on first day of trading. While the entire SaaS industry is supposedly in trouble, one company just proved everyone wrong by posting a 40% stock surge on its first trading day. Bending Spoons, an Italian software company, just went public and absolutely crushed expectations, and the reason why tells us something crucial about where tech is actually heading right now. Here's the genius of their strategy. Instead of building new products from scratch like every other startup, Bending Spoons has been quietly acquiring forgotten tech brands and bringing them back to life. We're talking about massive names like AOL, Eventbrite, Evernote, Meetup, and Vimeo, products that fell dead or irrelevant. But here's where it gets interesting. They're not just slapping a fresh coat of paint on these legacy platforms. They're using modern AI, streamlined operations, and ruthless efficiency to transform them into profitable machines. It's the opposite of the typical Silicon Valley playbook where you burn cash for years chasing growth at any cost. The market is clearly rewarding this approach because it actually makes business sense. While everyone else is drowning in unprofitable user acquisition costs, Bending Spoons is buying established user bases with decades of brand recognition and monetizing them intelligently. This is a masterclass in recognizing that the internet's graveyard is full of valuable real estate, you just need the right tools and mindset to develop it. What this really signals is a fundamental shift in how tech companies will compete going forward. The era of move fast and break things is giving way to something more mature: acquire smart, optimize relentlessly, and actually make money. If Bending Spoons can keep executing this playbook, they've just shown the entire industry a roadmap that actually works. Neocloud Together AI raises $800 million, leaps to $8.3 billion valuation. Together AI just became a unicorn's unicorn, and we need to talk about what this $800 million funding round actually means for the future of artificial intelligence. The company's valuation just exploded from $3.3 billion to $8.3 billion in just 18 months. That's a 150% jump that signals something fundamental is shifting in how the AI industry operates. Here's the thing that makes this different from typical startup hype: Together AI isn't chasing the same game as OpenAI or Anthropic. They're building infrastructure for open-source AI models, which means they're positioning themselves as the neutral hosting ground where developers can run alternatives to proprietary systems. In a world where everyone's worried about vendor lock-in and data privacy, that's become incredibly valuable. They're essentially saying you don't need to depend on one company's closed ecosystem, and enterprises are apparently willing to pay billions for that freedom. The broader implication here is that we're witnessing a genuine split in AI's future. On one side, you've got the closed-source giants hoarding their models and data. On the other, you've got this emerging infrastructure layer, companies like Together AI, that's betting the real money isn't in building the models themselves, but in democratizing access to them. This funding round suggests investors are finally getting it. The AI revolution won't be won by whoever builds the biggest black box, but by whoever controls the pipes that let everyone else build freely. Meta, like SpaceX, looks to turn excess AI compute into cash. Meta just made a move that could fundamentally reshape the cloud computing landscape, and honestly, it's brilliant strategy disguised as pragmatism. The company is building out a cloud infrastructure business to monetize its massive AI compute capacity, essentially becoming a direct competitor to Amazon Web Services, Google Cloud, and Microsoft Azure. This isn't some side project, this is Meta recognizing that it's sitting on billions of dollars worth of computational infrastructure and deciding to actually make money from it. Here's the context that makes this so significant. Meta has been investing heavily in AI infrastructure for years, building out data centers and GPU clusters to power everything from recommendation algorithms to their push into generative AI. But here's the thing, they don't need to run all that compute at full capacity all the time. SpaceX figured this out years ago with Starlink, turning excess satellite capacity into a revenue stream. Meta is applying the same logic to AI compute. Why let those GPUs sit idle when you can rent them out to startups, enterprises, and other companies desperate for AI resources? It's free money, essentially. The implications are massive. We're looking at a potential disruption of the cloud market at a moment when demand for AI infrastructure is absolutely exploding. Meta has the advantage of owning its own hardware, having deep expertise in large-scale systems, and frankly, not needing to make a profit on this business to justify it. That's a dangerous combination for incumbents. If Meta prices aggressively, they could capture significant market share from the traditional cloud providers who've been charging premium rates for compute access. This could accelerate the commoditization of cloud infrastructure, which is ultimately good for innovation but brutal for margins across the industry. Trump drops restrictions on Anthropic's Mythos and Fable models. Hashtag AI policy just got a whole lot messier, and nobody knows what comes next. The Trump administration just dropped restrictions on Anthropic's Mythos and Fable models, and honestly, this move perfectly encapsulates the absolute chaos we're watching unfold in AI governance right now. One day there are guardrails, the next day they're gone, and companies are left scrambling to figure out what the rules actually are. This isn't just about two models getting the green light, it's a signal that AI policy in this country is being made on the fly, with little consistency or long-term vision. Here's what makes this particularly significant. Anthropic is one of the most cautious AI companies out there, known for taking safety seriously and building constitutional AI systems. If even their models are facing this kind of regulatory whiplash, imagine what smaller startups are dealing with. The restrictions that just got dropped were presumably put in place for specific reasons, maybe concerns about certain capabilities or use cases, but now we're in this weird limbo where companies can't plan their product roadmaps because policy could shift with the next administration memo. That's not how you build a healthy tech ecosystem. The broader problem here is that erratic AI policy is actually worse than strict AI policy. Companies need predictability to innovate responsibly. When the rules change without warning, you get a race to the bottom where everyone's just trying to move fast before the next restriction lands. We're seeing this play out across the industry right now, and it's creating genuine uncertainty about whether we're building AI systems that are actually safe and beneficial, or just systems that happen to slip through whatever regulatory framework exists on any given Tuesday. The real question isn't whether these specific models should be restricted, it's whether we can ever establish coherent AI governance when policy keeps ping-ponging like this. The funeral for PlayStation discs has begun. PlayStation is officially killing physical games, and this moment marks a massive shift in how we own and control the media we buy. Sony just announced they're stopping production of physical discs for new PlayStation games starting January 2028, which sounds like a distant deadline until you realize we're already halfway there. For gamers who've spent decades building physical libraries, trading games with friends, and knowing they actually own what they paid for, this is a gut punch. But this isn't just about nostalgia or convenience, it's about fundamental control slipping away from consumers and into the hands of corporations. The business logic here is crystal clear from Sony's perspective. Digital distribution cuts out the middleman, eliminates manufacturing costs, and most importantly, gives them total control over pricing, availability, and what you can actually do with your purchase. When you buy a physical disc, you own it. You can resell it, lend it, keep it forever. Digital games? You're renting access to a license that can be revoked at any time. The shift to all digital also means less competition from used game markets that cut into their profits, which is why retailers like Pink Gorilla Games are sounding the alarm. This isn't just about one company, it's the entire industry's endgame. What's particularly troubling is how this reflects a broader tech pattern we're seeing everywhere. Whether it's streaming services, cloud software, or now gaming, the industry is systematically moving away from ownership toward permanent subscriptions and licensing. You don't own your music on Spotify, your movies on Netflix, or increasingly, your games anywhere. This consolidation of control has real consequences. Companies can raise prices without competition, delete content whenever they want, and leave you with nothing if they decide to shut down servers. The funeral for PlayStation discs isn't just about physical media, it's another step toward a future where we own almost nothing and rent everything from tech giants. Anthropic is bringing back Claude Fable 5 globally after US lifts export control order. Where can enterprises access it? #Claude Fable 5 is back, and it changes everything about AI regulation. The most powerful AI model ever released to the public just came roaring back from a 3-week government blackout, and honestly, this moment tells us everything we need to know about where AI policy is heading. Anthropic's Claude Fable 5 was yanked offline on June 12 when the US Department of Commerce slapped an emergency export control order on it, essentially treating cutting-edge AI like nuclear technology. Now, less than a month later, those restrictions are gone, and the model is available globally again. This isn't just a technical story, it's a window into how governments and AI companies are learning to navigate this completely unprecedented territory. Here's what makes this wild. Anthropic had just launched Fable 5 and a cybersecurity-focused variant called Mythos 5 when the government essentially said pump the brakes. The company had to shut down global access almost immediately, which meant enterprises and developers outside the US suddenly lost access to what they'd been promised. The fact that the Department of Commerce reversed course this quickly suggests either they realized the order was too aggressive, or Anthropic made a compelling case that the restrictions were counterproductive. Either way, it shows how fragile and reactive AI governance still is. The bigger picture here is that we're watching a real-time negotiation between innovation and national security concerns. The US government is clearly worried about advanced AI capabilities falling into the wrong hands, but they're also learning that blanket export bans might actually hurt American companies more than help. If Anthropic can't sell to global markets, they lose revenue and competitive advantage to companies in other countries who face no such restrictions. This reversal suggests policymakers are starting to understand that nuance matters. You can't just flip a switch and expect the global AI economy to cooperate. The question now is whether this becomes the template for how future AI models get regulated, or if this was just a one-time correction. Sony's PlayStation puts a nail in physical media's coffin. Sony just made a move that could reshape the entire gaming industry, and honestly, it feels like we're watching history repeat itself in the worst possible way. The company announced that future PlayStation consoles will ditch physical media entirely, going all digital. If that sounds familiar, it's because Microsoft tried this exact strategy with the Xbox One back in 2013, and it became one of the biggest PR disasters in gaming history. Consumers revolted, Microsoft backpedaled within weeks, and the lesson seemed crystal clear: gamers still want physical ownership. Yet here we are in 2026, and Sony is apparently betting that enough time has passed for people to forget why this matters. The business logic is tempting from Sony's perspective. Digital only means lower manufacturing costs, no supply chain headaches, and most importantly, complete control over the secondary market. When you own the only distribution channel, you control pricing, you eliminate used game sales that cut into profits, and you can push subscription services like PlayStation Plus more aggressively. It's the same reason every tech company dreams of going digital only. But there's a critical difference between what's profitable for a corporation and what consumers actually want, especially when we're talking about something people are spending $500 to $700 on. What makes this timing particularly interesting is the broader context of AI and digital rights. We're in an era where people are increasingly skeptical about corporate control over digital content. The whole debate around AI training on copyrighted material, subscription services raising prices, and companies removing access to digital purchases has made consumers more protective of ownership. Choosing this moment to eliminate physical media feels tone-deaf. Sony is betting that convenience and digital ecosystems will win out, but they're ignoring a fundamental shift in how people think about digital ownership and corporate power. If this backfires, it won't just hurt PlayStation sales, it could accelerate a broader consumer movement demanding actual ownership rights in the digital age. Thanks for staying updated with Neural Brief. Subscribe and hit the notification bell so you never miss tomorrow's biggest AI breakthroughs. See you tomorrow.